Hello, this is Professor Richard Holozak at Baruch College talking about limit order books. So, any of you that have worked with a financial information system or maybe even have a brokerage account may have seen a screen that looks like what I have up here, one of these two. Maybe you're looking through a Bloomberg or a FactSet or a Reuters terminal. And probably what you've seen is maybe about 60 or 70 different data points that are flashing at you like crazy, especially when the market is open. And you might have been wondering what's going on these screens. Well, at their most basic, these are what we call order books. And so you'll see a lot of terminology that's thrown around the topic of order books. And so the purpose of this lecture is to just talk a little bit about the basics of order books. So first up, each exchange is going to maintain an order book for each security that they trade. And so that means if you looked at the New York Stock Exchange or BATS Exchange or NASDAQ, you would see that for every stock, for example, for every stock that they trade, they will have a limit order book. Sometimes these things are called limit order books or centralized limit order books. Just as shorthand, folks simply call these order books. When someone wants to trade a stock, what they will do is they will submit a limit order to an exchange and they will provide some information, including the security symbol. It might be the stock ticker or the QSIP or whatever other identifying information they need to tell the exchange what security they're interested in trading. They will also provide the direction, whether or not they're willing to buy or sell this particular security. Third, they'll provide a limit price. This is the price at which they would like to trade. So, for example, if they're submitting a limit buy order, they will give the price at which they're willing to pay to buy the stock. If they're submitting a limit sell order, they'll provide a limit price, which is the price at which they're willing to sell the stock. And last but not least, the size, the number of shares or contracts that they are willing to buy or sell. So these four basic things come together to form a limit order. The buy limit orders become what we call bids in the order book, and the sell orders become what we call asks. Sometimes you'll hear asks also called offers. So people will talk about the bids and the offers in the book, or they'll talk about the bids and the asks in the book. The exchange will arrange the orders in the book according to what we call a price time priority. Basically, what this means is orders are arranged in the book first according to price. And so again, if we look here at the this example, we can see that the bid side prices are arranged here: 33.75, 33.75, and then 33.74. So bid prices are sorted from highest down to lowest. On the ask side, prices are sorted from lowest up to the highest. If two orders are submitted at the same price, they're sorted according to the time at which they were submitted. So for example, back to the bid side here, we have two orders that were submitted at the same price, $33.75. Order 101 came to the exchange before order 104. So while they are tied on price, order 104 is put below order 101 because of the time priority. Okay? So every new order that gets submitted for a particular security will go into the order book and it will be sorted according to this logic. So now what I'd like to do is run through the steps of building up an order book. And let's assume that the market has just opened and we have a completely empty order book. There are no buyers, there are no sellers that are into the market. So the first thing we're going to do is we're going to add an order. So a trader will submit an order to buy 200 shares. I think the example here is Intel Corporation. And their broker will submit some information, including, as we mentioned before, the security they're interested in buying, the direction, in this case is a buy, price, and the number of shares. So here's what the trader wants to do: buy 200 shares of Intel. The limit price, what they're willing to pay, is $33.75. What the broker will do and the exchange will do is they will add an order number and the time to that. And as we might expect, the buy order will go up to the bid side on the book. Because there's no other orders, that gets sorted right to the top. You may notice often the bid size is just shown as a single digit here. What this indicates here is the lot size is 100 shares. So to indicate we're buying 200 shares, we just put the number 2 in the order book. Now we have another order coming in, and this order is to buy 500 shares of Intel, but they are only willing to pay $33.74, so their bid price is a little bit lower. So again, we've got the same kind of information. The exchange will add a unique order number and the time, and that will go into the book. And again, given our price time priority, this particular order 102 comes in at level 2 on the book. All right, a third order comes to the market, and this time it's to sell 300 shares. So the trader has said, I want to sell 300 shares of Intel, and my asking price is going to be $33.78. So I'm going to accept anyone who wants to give me $33.78, I will sell my 300 shares to them. And because this is a sell order, it's going to go over to the ask side of the book. Okay, now we have a fourth order coming to the market. And here's another buy order. So we're going to buy 100 shares of Intel, and the price we're willing to pay is $33.75. So if you want to pause for a second, let's think a little bit ahead of time and see if we can predict where this is going to go into the book. We see that they're going to bid $33.75, and when we look up at the book, we see that there's already an order there for $33.75. So what should happen? Well, the order matches the current best bid price, but it was submitted later, so it should go into level 2. So the first thing that should happen is order 102 will get moved down in the book, and then order 104 will get inserted here just above it. And so in this way, order 102 got pushed down and order 104 gets put into the market. And why is this? Because we're maintaining a strict price and then time priority. All right, now let's add an order 5. Here it's going to be to sell 200 shares, and here the asking price is $33.77. So again, you might want to pause and think for a second, where will this end up in the book? Right? We see that it improves on the best asking price. So it's going to jump over the order here, 103, that's in the book. It's going to push that down, and our new order here to sell 200 shares should be at the top of the book. So order 103 gets pushed down, and here's order 105 now at the top of the book. Okay, so here we have our book now. It's all set up with our 5 orders in it, and I just want to take a brief moment to talk about this term liquidity. Liquidity has a lot of different meanings, whether you talk to folks who work on the street, or you talk to academics, or you talk to practitioners. Everyone kind of has their own sort of definition. Even folks in the same industry, or even among academics, people will have their own sort of meanings to this. One thought here is we can think of liquidity as the ability to trade at a reasonable price at a given time. So if I came into this marketplace and I really wanted to buy some Intel stock, would there be a willing seller there ready to trade with me? And so in order to do that, we need folks who have put up limit orders. So the fact that there are 2 limit orders here to sell, and they total up about 500 shares, and there's 3 limit orders here to buy, and they show about 800 shares. This shows a little bit of liquidity. There are willing buyers and sellers already in the market. So each time a trader puts a limit order into the market, they're adding liquidity, we say. They're giving the opportunity for buyers and sellers to trade in that market. And in any marketplace, generally that's a good thing. Okay, the more limit orders, the more liquidity. Another term for this, you'll often hear people talk about the depth of the market and whether or not there's a lot of shares at a lot of different prices to buy and to sell. So sometimes folks will use the term depth when they're talking about liquidity and vice versa. Here's just a quick example. Again, this is those original two order books, and I just want to point you to two of these examples. On the right here, we have Intel Corporation, which, if you've ever seen some NASDAQ stocks, Intel is what we say is a fairly liquid stock. And if we look here at the size, here we see that there's actually 31 lots of 100 shares. There's 3,100 shares that people are willing to buy. And look here, there's 212 lots of shares where people are willing to sell. Okay, so that's 21,200 shares. So that's quite a bit of liquidity that's going on there. A lot of buyers, a lot of folks willing to buy, a lot of folks willing to sell. If we look over here at overstock.com, people would generally say that Overstock is a less liquid stock. And when we look here again, we see that really there's only a buyer for 500 shares and maybe 600-700 shares at these prices at the top. And here we have some sellers, maybe 300, 400, 500, 600, 700 shares. So we can see there's a lot less interest from traders to buy and sell Overstock. So to sum this up, what we would generally say when we see all of these willing buyers and sellers, we'd say Intel is a fairly liquid stock. When we look at the order book for Overstock.com, we would say, you know what, that's a less liquid stock. There seem to be fewer traders willing to buy and sell that stock. Another thing to look at is when we look at an order book, we're going to look at what we call the top of the book. And that's this very first level here, the top level. And what we sometimes want to explore is the first order that's at the top. And what we'll look at here on the bid side is we say there's 300 shares that are ready to be purchased at $33.75. And so right now that's the top of the book. The best bid price is $33.75, and if we combine these two, there's 300 shares ready to be bought. On the ask side, there's just one order up here, and there's 200 shares ready to be sold at $33.77. And so that's what's considered the top of the book. The term spread is going to relate to the difference between the best bid and the best ask price. Or another way around is saying if we take the best ask price, $33.77, and we subtract from it the best bid price, we get the spread. Okay, it's going to be the distance between these two. And so currently, we would say right now that Intel has a 2-cent spread. If we go back to the prior slide here, again, we can point out this is a live shot of Intel. We see that it's collapsed to a 1-cent spread. Here's 33.88, and the ask is 33.89. So it's actually a 1-cent spread. So it's a very sort of tight market between buyers and sellers. We go back to the less liquid Overstock.com. We see that its bid and ask spread is a little wider, so 22.98 to 23.08. So it looks like about a 10-cent spread on Overstock.com. So again, this is also just an indication of liquidity. Intel, very tight spread, 1-cent spread, and lots of willing buyers and sellers. Overstock.com, fewer willing buyers and sellers, and the spread is a little bit wider. Okay, so again, top of the book, and we can look at the spread. This is also another measure of liquidity. Okay, well, what else can happen in an order book? Well, traders can decide to cancel orders. So someone who's put an order into the book and maybe no one's decided to buy from them, they get a little bored, they want to move on to trade other stocks, they might cancel an order. So here, let's assume that a limit order is canceled out of the book. And typically on the exchange, it's a very simple message. It simply says, hey, look, cancel order number 105. The exchange already knows what that order is all about because it has that information from when the order was added. And so that's going to have the following effect. The first thing it's going to do is it's going to wipe out this order from the book. And so that's going to get get moved out of the way. And what do you think next? The next order in the book is going to get a chance to move up because now it is the best ask in the book. Okay, so now that we spent a little bit of time talking about limit orders and how limit orders add liquidity in our order book, now we want to switch track and talk a little bit about market orders. Market orders are going to do the opposite. They're going to take liquidity out. And let's take a quick example as to how we do that. So the feature of a market order is that it's going to trade immediately at whatever the best price is in the book. For example, a market buy order will trade immediately with the best asking price that's in the book, whereas a market sell order will trade immediately with whatever the best bid price is in the book. So here we have a market order that comes in, and the intent here is for the trader to sell 100 shares. Now, you may notice there's no limit price provided. And again, that is because the market order will immediately sell at whatever the best bid price is in order to satisfy that market order. Okay. In this case, the market order seller is demanding 100 shares, whereas the buyer here from order 101, you may remember, was looking to buy 200 shares. So clearly, if there's 200 on the bid ready to be bought, and we have 100 that need to be sold, there's going to be enough here to satisfy that order. And so really the only effect that's going to happen on the order book is the 100 shares will be sold at 33.75, and this size, this bid size, will be reduced by however much the market order is looking to sell. And so basically we just see that 200 shares went down to 100 shares. Just do it quickly again. We have 200 shares on the bid. We do a market sell of 100 shares. We lift 100 shares out of the book, and we're left with 100. The trader who had submitted that market order, order number 106, they have their order completely filled. They were looking to sell 100 shares, and they certainly did. They sold it for 33.75, and they go away happy. The trader who submitted order 101, they're in a little different situation. They're going to get a message that their order was partially filled. Again, recall the original order was to buy 200 shares at 33.75, and they only were able to buy 100 shares. So they will end up with 100 left, as we say, on the book. So this is now the new state of our book after that market order executed. Let's take another example. And this time we're going to try and sell a little bit more. Here we have a new market order, order 107. The trader is looking to sell 400 shares. And if we just take a quick look up here at the market, we see that there's really not 400 shares at the best at the top of the book, but we may actually have to use more orders in the book to get up to this 400 shares. So order 107 comes to the market. They're selling 400 shares, and they're going to hit the bid side and attempt to lift 400 shares out of the book. Okay, so let's do this a step at a time. Order 101 is good for 100 shares. And so we will immediately execute this order, and order 101 is completed. So they're out of the book. Order 104 is also good for 100 shares. So we will go ahead and sell 100 shares to order 104, and order 104 will be finished. At this point, our market sell order has 200 remaining. Remember, we sold 100 shares to order 101, 100 shares to order 104, and now we have 200 shares. So we're going to walk down the book and now sell 200 shares to order 102. Okay. As a result, what should end up happening is order 102 will move up to the top of the book, and its size will be reduced from 5 down to 3. So again, this will be the final state of the book after this, but let's just back up a real quick second here. We have 400 shares coming in. We sell 100 to order 101. So order 101 goes away. We sell 100 to order 104. Order 104 goes away. And we sell the remaining 200 to order 102. And taking away 2 there, we'll end up with 3 left in the book. So we go back and remember the trader who submitted order 101 now receives a message that their order is completely filled. Okay, between the prior 2 market orders, now they're filled. They're very happy. The trader who submitted order 104 gets a message their order was filled. They wanted to buy 100 shares and they got their fill. The trader who submitted order 102 is going to get a message that their order was partially filled. They wanted to buy 500 shares and 300 remain in the book. The trader who submitted the market order 107 will receive a message that their order was filled at 2 prices. 200 shares were sold at $33.75 and 200 shares were sold at $33.74. And so what this trader will learn is that their average price, what we call the weighted average selling price, was 33.745. And it's just relatively simple algebra here. It's the number of shares times the price plus the number of shares times the price. And that whole thing is divided by the total number of shares that were sold. Okay, so this is how we do a quick weighted average price. The same logic works if you're on, if the market order were a buying order. So again, the lesson here is that limit orders are going to provide liquidity. They build up the book, and when market orders come to the book, they're actually going to take away liquidity. They're going to take away those shares. So let's do some exercises. Let's look at our limit order book as it is right now. We've got order 102 here for 300 shares at $33.74. We've got order 103 left in the book, 300 shares at $33.78. And let's add 4 more limit orders. Right? What you may want to do, just as a little exercise here, is pause the video and sketch out on a piece of paper where you think these 4 limit orders will go and what the order book might look like after they've all been submitted and the prices and times have been sorted. So we can take a quick break there. Okay. Is this what you got? Hopefully. You didn't just fast forward to this. What we see here is order 108 came into the book at $33.74. Order 109 came in at $33.73, a little bit lower. Order 110 was a sell order that came in at $33.77, and order 111 came in at $33.78. So here are some questions. First question, why is order 108 at level 2 in the book? Why did order 108 end up here in the book? Again, if you want to pause and see if you can answer that one on your own. The main reason why order 108 is at level 2 in the book is even though it ties for price with order 102, that is the $33.74, it came in later, at a later point in time. And so therefore, given the price time priority, order 108 comes in next in the book. So they're tied on price, $33.74, but order 108 came in afterwards, and so that's why they are ordered in this way. Why did order 103 get pushed down in the book? If you remember at the original setup, order 103 was at the top of the book, and somehow it got pushed down, and let's see why that might be. Order 110 came in to sell at $33.77, and because $33.77 is a better asking price, a lower asking price than what order 103 had here, order 103 got pushed down a level, and order 110 ends up getting slotted in there at the top of the book. Next question, what is the current best bid and ask, or what we sometimes call the BBO, the best bid and offer? And that's easily found out. We just look at the top of the bid side, $33.74, and at the ask side, it's $33.77. What is the current spread? That's simply going to be the difference, 33.77 minus 33.74. And so currently there is a 3-cent spread between these two. So that was a nice exercise on rebuilding, if you will, our book with 4 new limit orders. Okay, well now we can do some exercises with market orders. And again, I encourage you after we show these transactions to, or these orders coming in rather, to go ahead and try and write down your answers before you go forward. So let's get a couple of market orders in here. So here we have a market order to buy 900 shares and another market order to sell 400 shares. Okay, and so the questions that we're going to have are, what will be the average buying price for order 112? What will be the average selling price for order 113? And then what is the order book going to look like after these two orders are executed? And again, we're going to assume that no other limit orders are submitted at this time. So I invite you again to pause, take a few minutes to write out some answers, and go ahead and resume when you're ready. Okay, so before I adjust the book here, we just want to take a quick look and revisit these two transactions. So the first is, what's the average buying price going to be for order 112? And to find that out, we need to look at what order 112 is going to do to the book. Order 112 will hit the ask side of the book because it's a buy order, and it will immediately lift 400 shares at 33.77. And so that's going to be the first part of the fill, 400 shares at 33.77. Okay, but again, we're demanding 900 shares, so the order is going to continue on. It's then going to get 300 shares at $78. There's 300 shares at $78. Okay, but the order's not done. It will continue on to the next level in the book, where it will get 200 remaining shares for 33.78. So that's actually a little bit more math than what I can do in my head. And so what I've done is, if I can get my spreadsheet here, just done a quick spreadsheet. So here's 400 shares at 33.77, and we multiply those together. Here's 300 shares at 33.78. We multiply those together. And here's 200 shares, 33.78, and we multiply those together. We sum up the total shares that we've purchased, and we sum up the price times size. And then finally, by dividing those two, we end up here with our average buying price. So $33.7756. So this is a weighted average buying price that our buyer achieved. So just doing out the math, we get that 33.77 and change there. Okay. What would the average selling price be for order 113? In order to find that out, we have to discover what the effect order 113 will have on the book. And so here we're trying to sell 400 shares at the market. So the bid side is engaged, and we'll sell 300 shares for 33.74. The remaining 100 shares will be sold also for 33.74. So here it seems pretty straightforward. 300 shares at 33.74 and 100 shares at 33.74. The average selling price will be 33.74. I sort of don't even need to do the math because it's the same price here. And then finally, the last question was, what would the order book look like? So I'll just back up real quick here. Remember, the buy order is going to take out order 110 and order 103 and take out 200 shares of order 111. The sell order is going to take out order 102 and then take out an additional 100 shares of order 108. Okay, and so here we end up with, that's 400 shares left at the best bid, and here's 700 shares left at the best ask. So this would be our final state of our order book after these two market orders are executed. Okay, I think that's going to sum it up for right now. What we've basically covered here is the basic definition of a limit order book. We've demonstrated and with exercises how limit orders affect the book, how limit orders are used to build up the book. And then we've also explored how market orders affect the book in terms of how they remove liquidity or remove shares out of the book. And I've also given you a few notes on a couple of ways that we can measure liquidity. There's obviously much more detail that we can get into, but hopefully this provides you with a nice summary to get started.